Alright, welcome to the CFO channel. My name is Ali and I simplify accounting and finance concepts. In this video, we're going to talk about margins. No, not those margins. We're going to talk about gross margin and profit margin. I was inspired to make this video after some feedback from one of the subscribers to this channel. If you've ever been confused about the terms profit margin or gross margin, this video will help you understand what those terms mean. And watch until the end of this video because I will reveal one pro tip to help you tell the difference between the two terms. The first thing you need to understand about margins is that it typically refers to a percentage. If you look at net profit margin, it's usually expressed as a percentage of revenue. If you look at your gross profit margin, it's also expressed as a percentage of revenue. Now, if you look at the term profit margin, it usually starts by looking at a company's net profit or net income. The net profit or net income that a company has earned is usually calculated as revenue less all of the company's expenses, and then at the bottom you usually get something called net income or net profit. So whenever you're looking at a set of financial statements for any public company, if you look at the number at the bottom of the profit and loss statement or income statement, that profit is what you would call net profit or net income. Now, when it comes to calculating the net profit margin of a company, the calculation is actually quite simple. You take net income or net profit at the bottom of the income statement, and then you divide that number by the company's revenue. That will give you a percentage. And that percentage is your net profit margin or net income margin. Let's take a look at an example so that we can really understand what this concept means. In this example, we'll take a look at Apple's financial statements and calculate the company's net profit margin. In 2021, Apple had revenue of $365 billion, and its net income was $95 billion. Now, if we divide Apple's net income by its revenue, you will get a percentage, and in Apple's case, that number is 26%. This is Apple's profit margin. This means that 26% of Apple's revenue was converted into profit, or said another way, for every $1 of revenue Apple made, they converted 26 cents into profit. Now, in order to compare Apple's profit margin of 26%, let's take a look at another company's profit margin. In this case, we'll take a look at Google's net profit margin and see how it compares to Apple's. Okay, so to get Google's net profit margin, you would take its profit for 2021 of $76 billion, and then you would divide that by its revenue of $257.6 billion. The result of this would be a net income margin percentage of 30%. So in conclusion, Apple's profit margin is 26%. Said another way, for every $1 of revenue Apple made, it converted it into 26 cents of profit. Google has a profit margin of 30%. And again, said another way, that means for every $1 of revenue Google earned, it converted that dollar into 30 cents of profit. Hence, we can conclude here that Google's net profit margin of 30% is higher than Apple's margin of 26%, in which case Google is much more efficient at generating profit. Now, when it comes to gross profit, it is usually calculated by taking revenue and deducting all of the expenses that are incurred to generate that revenue. However, the one key difference that you need to understand about gross profit is that unlike net profit, where you take revenue and deduct all of a company's expenses to get to net profit, for gross margin, you only deduct a certain portion of those expenses, and in this case, it's only those expenses that are incurred to generate revenue. What are those expenses that are incurred to generate revenue? Well, it really depends on the type of business you're running. If you're a business that sells inventory, the way you would calculate gross profit is by taking revenue and deducting cost of goods sold. Cost of goods sold is usually all of the inventory that you've sold to generate the revenue you just made. If you run a software business, gross profit will be calculated by taking revenue less payroll. Why payroll and not cost of goods sold? Well, for a software company, You don't sell inventory, so you don't have any cost of goods sold. Your biggest expense is usually payroll. So the way that you would calculate gross profit for a software business is by taking revenue, deducting payroll, and coming up with gross profit. Why is gross profit important? Gross profit is usually used to gauge the health of a business. If you have a large gross profit number, it usually means, number one, that your costs to earn revenue are quite low, which is good. And number two, it means that you have money left over to cover all of the other expenses of your business. Now, if we take two hypothetical businesses, let's say you have business A, which makes revenue of $1,000, its cost of sales is $500, therefore its gross profit is $500. And then you have business B over here, which makes revenue of $1,000, its cost of sales is $800, therefore its gross profit is only $200. Which business would you rather own? Business A or business B? Business A, of course, because it has the larger gross profit. Now, gross profit margin, similar to net profit margin, is calculated as a percentage. The way you would calculate this percentage is by taking your gross profit for the business and dividing it by revenue. This would give you a percentage, and that is your gross profit margin. Now, let's take a look at a real-world example again, and we'll calculate the gross profit margin for Apple and for Google, and we'll compare the two.
Okay, so to calculate Apple's gross profit margin, you would take its gross margin for 2021, which is $152.8 billion. And then you would divide that by revenue of $365.8 billion. When you do the math, the result will be 42%. Now, to get Google's gross profit margin, it will take a few steps. The first step you do is you take revenue of $257.6 billion, and then you deduct cost of revenues right here of $110.9 billion. If you do that, you will get Google's gross margin, which is $146 billion. Now, if we divide this gross margin that we just calculated of $146 billion by its revenue of $247.6 billion, you will get a gross margin percentage of 57%.
So, Apple's gross profit margin is 42%. Said another way, it converts every $1 in revenue into 42 cents of gross profit. Google's gross profit margin is 57%. That means for every $1 of sales, it converts that dollar into 57 cents of gross profit. Hence, we can conclude here that Google has a higher gross profit margin than Apple does. Now here's a pro tip. If you're finding all of this discussion about profit margin and gross margin confusing, just remember this. When someone refers to net profit or net profit margin, it usually involves taking the number at the very bottom of a company's income statement, net income or net profit. When somebody is referring to gross profit, it's usually not the number at the bottom, it's usually a number in the middle of the income statement calculated by taking revenue and deducting some version of cost of sales. If you like this video, give it a thumbs up and check out my previous video here where I talk about the basics of accrual accounting.